Good morning, everyone.
Good morning.
So we have two topics today. One is on this forensic audit. I will put rather a investigation audit. One is through lenders and another is through under IBC, which we call as transaction audit. That will be covered by me. And one session will be taken up by Sandeep on the IBC front. So we'll start straight. One is on the lender based. Usually what happens, we have seen the NPA ratio which has grown from the last 3 years, and now again it will grow further with the COVID coming in, and the larger share is more of the PSU banks which we have seen so far in our experience goes as compared to the private banks like HDFC and all. There are few private banks, the Yes Bank or even ICICI. In some places they are also part of the thing of the consortium. One sec. Hello. Yeah. Waiting. Admitted. This will keep message coming to me constantly. I think someone's this music is sorry, the speaker is on. If everyone can keep on mute, we can have the discussion comfortably. So usually the scope, what I'm covering here is the scope of work we receive under the lender based audit, investigation audit, and under the transaction audit, and my practical experience which I have came across rather than going for more theoretical. So the scope is ideally very pretty standard, which is adopted and has been given by SBI over here, which talks largely on the money trail and the end use of the funds. It talks about the talks about tracing the source and genuineness of the contribution by the promoters. So here also we see like where the money is coming from. If it is a network of a group companies and they have sanctioned the money from the other banks, and that money is also being brought as part of the promoter contribution. But it again depends on the scope, how the scope is about. So the scope is only for the target company and it doesn't include the associate, subsidiary or holding company. We cannot cover that. So sometimes banks make the scope very smartly on that front. Another thing which we have to observe on the operation front is with regards to the invoicing, billing and the returns, what it is there. Is there any spike in all of a sudden? There is an inflation in the turnover. And there are transactions which are of the arm's length, especially with the related party, which we have to observe it. And this also becomes part of the circular trading transactions. So the objective of this is to inflate the turnover to increase the drawing power limit over here, and having a breach of the trust on breach of I'll say the terms as well. We have observed in our practical terms that the company also have the other bank accounts which are outside the consortium, and whatever the inwards are coming from the operations or through other means, that is being parked over here, and from here the payment keeps on happening, and it may be for the business or it may be outside the business. So usually the scope covers including the not only the accounts which are part of the consortium but also the other bank accounts. Concentrating transaction I mentioned. Then if there are any unsecured loans which has been made or received, which we have to cover, what are the terms and conditions for that? Is this with related party or how is it? Then prior to having this forensic audit come investigation audit, if any special audit has been conducted by any regulator or by the banks or independent agency, then what are the findings? Are there any red flags on that, and what actions has been taken upon that based on the minutes of meeting, what has been agreed with the promoters? I still hear some background noise. If that can be kept on mute, it will be good. And we have the another area like details of the substantial debt if it is being raised, and the reason for raising that if it is not required for the business, making the business model itself unviable. Verifying the receivables, so many times we have come across that the receivables are the related parties or even the employees or the mock parties who doesn't actually keep exist. So we look on those front as well. Then finding the details of the assets of the units, promoters and its partners in terms of what all assets he has and whether.
Mitesh,
Yeah,
Mitesh, can you mute all?
I can mute all. Let me see.
Because background noise still coming.
Then the last item, which is usually there in the scope, is to discreetly review whether any assets which are owned by the promoters in terms of the titles as well, and these are being taken from the borrowed funds and has not been reflected in the balance sheet. It may be in the personal capacity of himself or any of his family members. And the approach what we adopt over here is based on the RBI circular. Now the RBI says very specifically that auditors should report on fraud. It doesn't still mandates, but it uses the word should. So should the bankers largely insist that you be very crystal clear that whether there is a fraud or not a fraud, because it helps them to take up the case accordingly with the EOW. And therefore, to support our argument, we take the help of one more parameter we call as unusual indicator, which will help that these indicators are quite unusual and it is a signal that the transactions are fraudulent in nature or there is a diversion of funds. Now, to say there is a diversion of funds and there is fraudulent, one cannot comment, yes, he has some leeway in that as an auditor on that fund, because to prove that transaction is a fraudulent, it becomes on the part of the auditor that how it is fraudulent. Though everyone understands the funds has moved out, the regulator also accepts the argument that there is a diversion of funds. But to prove it is a fraudulent, there is a very thin line on that, and we need to, if we are very cautious on that, we can take that stand. There is one more angle over here, which is called as that there is no intention to pay, whereas it has been proved, okay, there is a diversion of funds, and if intention is not to pay, the people, those borrowers are classified as willful defaulters. So that is also one more category the banker considers on that. Now I'm coming to few of my examples which I have came across during my course of audit. So usually if bank uses the scope for 4 years, 5 years for the period prior to the start of the initiation date, we observe there is a spike in the sales and there is an increase in stock trading activities or manufacturing activities, but largely that is then is reduced over a period of time and the amount has been consumed as a write-off of the debtors or the stock. The cost of goods sold gets increased. We have seen, now I'm taking one more variety of the business, which is a EPC. So in EPC, what happens largely, the big contractor wins the jobs and then they award it to the subcontractors. These subcontractors are also observed, their related party is one of the GMs there who owns that company and the job is given to him. Money is also paid either in form of advance or in form of the work completed. But when we look for the measurement sheets and the relevant certificates, those certificates are not being made available. Vis-a-vis, even if we see what is the material being consumed by that contractor, or there is any lender's independent engineer audit report available. So that report also, to our surprise, we see that his appointment is also not independent. That is also suggested by the same borrower which bankers have, and there is a collusion as well on that. So we extend even that findings over here. Then circular trading transactions, which I refer, like there are 5 parties with whom we have purchases and same parties we sell. So we buy from Mr. X, we sell to Mr. Y, we buy from Y, we sell to Z. The materials are also quite common over here. It includes both the domestic as well as the overseas transaction, both import and exports, in the form of IC sales. Then RBI policy is very clear that merchant trading transaction should not be admitted in the course of their LC discounting facility. So here again we have observed that the borrower violates those norms and do the merchant trading transactions and opts through the LC discounting facility. So here what happens is the importer is being paid through the LC discounting, whereas there is no similar security cover he has for his sales. And then the customer will say the material is not to the mark, or there is some fault in the quality, or some or the other reasons. Or he may even say he doesn't have the money, his money is also stuck. And the borrower is getting into the trap. That is how it is being demonstrated. But if one uses commercial wisdom, then the business in which he is, if his channel partner, the predecessor, asks for the security, it is very much implied that he also needs to have his cover on that, whether it is through the insurance cover or through the LC from the customer, whatever form he is ready to have, so that his money is secured. But he is ready to take such wild decisions because his own money is not involved. We conduct even on this the physical visits of the customers or vendors. We find that those vendors or customers are the residential addresses, they do not exist over there. Even from the desktop search, if we do, if there is a sale of 100 CR to Mr. X, and X is a limited company, if I look from the MCA and I see how much his purchase is merely 20 CR. If his gross purchase is 20 CR, then how my individual sale to him can be 100 CR? So that itself is a questionable transaction, that such sales are fictitious and the money has gone out from the system. In that way, they increase their debtors and stock, also increase their drawing power limit accordingly. Such OPEX transaction also happens on the CAPEX front as well, where the assets are being acquired and advances has been paid, but the assets are not to the mark, or very high value of the money has been paid. So the proprietyness angle, if one is using on that, maybe on the land acquisition front or on machinery front, one can understand that how the money is going away from the system. If it would have been his own money, he would have taken all this prudence. The next observation which usually we come is on the money which is earned from the operation is being parked in the non-PRA account outside the consortium, and it is being taken from there. There is a high concentration of the sales transactions, or the work is being given to the subcontractor. This we discussed. Then even if we compare the material movements, whether those material movements has been genuine or not, if it is a proprietor or a partnership firm where we cannot obtain the details from the MCA, or even if it is obtained and it is matching, if I want to go further to the last flag, I see the material movement where the vehicle number what is mentioned in the LR. If I do my desktop search, I will find that vehicle number is not of any particular lorry, but it is of the two-wheeler or it is of a passenger car. One can understand even those transactions are not clear and clean, suspicious. But having said that, one cannot prove that those transactions are fraudulent in nature or there is intention, but those points can be very well captured in the report, and it can give the lenders the insights how the things are happening, and they can question definitely to the borrowers on those lines, and it can help the lender to frame up a opinion whether there has been a siphoning of the funds which has happened or not. This is that, because they have to file the case with EOW also, and going forward this account may turn into a NPA, post which it may go for IBC also, where resolution professional also will be looking on those lines. So any questions as far as lender-based forensic is concerned? I can move otherwise then to the second part. Happy to take that.
Mitesh,
Yeah.
how about short-term and long-term funds management? I mean, using long-term, short-term.
So I missed that. Yes, you're right. So if short-term money has been borrowed and those money has been used for the long term, okay, we can have a report that it is a non-compliance to your sanction agreement, but it doesn't indicate that there is a diversion of funds and fraud has happened. Because if the transaction is genuine enough, then it is becoming difficult to prove that.
Yeah, right.
So long-term money used for short-term, there is a less concern, but if it is a vice versa, yes, there is a concern because the borrowing rate for the short-term is on the side.
Because there generally the working capital no adjustment what we are talking about the data stock starts happening. I mean
Correct.
that's what.
Yeah, yeah,
Thanks. Yeah.
yeah. Anyone else? Can I move to another topic?
Yeah, Mitesh.
Yeah, yeah, Ashna.
Yeah, with regard to housing finance,
Mhm.
what are the tools that you use for investigating a collusion between a builder and the borrower or the customer?
So on the tools, largely we do a overt review, and as far as tools are concerned, we use Idea as a software because these transactions are very limited. It is even for a say I'm talking a borrower account of a HFC client and not HFC per se, then it doesn't require much of a tool on that. While I have other discrete review, I have the other parallel way of working in terms of we have the mock vendor, mock customers, and we have the agencies who have the liaison with the or nexus, I will say, with the regulators, where if he has purchased a land in some other state or in other country, and we have some insights of that, we can get those records of those assets which has been acquired. Fine, then I move to the next area, which is on the forensic audit under IBC. We call as a transaction audit under the IBC. I'll just give a little background of that. Under the IBC, since it is a very time-bound work activity which one needs to be finished. So the resolution professional, interim resolution professional rather, I'll say, he appoints the transaction auditor within the 7 days of the CRP initiation date, and the audit needs to be completed within 75 days of the initiation date, and post which there will be a discussion with the COC, with the resolution professional. Many comments will be obtained from the borrower, and the conclusion has to be drawn in a span within a time frame of 105 days. That is another 30 days has been given. Post which the resolution professional with the help of lawyer files the PERF application with the NCLT, which is called as adjudicating authority. PERF application is nothing but it is a new, I'll say, another name of the transaction audit, where P stands for prevention, U stands for under invoicing, under valuation, F stands for fraudulent activity, E stands for extortionate transactions. There are specific sections which talks on each of these 4 categories of transactions, and we'll go now by each one after the another section. So section 43 talks for the preferential transactions, 45 of the IBC code talks for the undervalued transactions, 50 talks for extortionate transactions, and 66 talks for the fraudulent transactions. Here usually the scope is given is for 2 years if it is a, and that 2 years will be considered if it is for the related party, otherwise it is 1 year prior to the CIRP order date. But for section 66, fallback period is not defined. So sometimes what happens, resolution professional ask us to cover for the last 5 years, beyond which if one wish to go, yes, he can go. But there is no point because people will not be available, system will not be, books of accounts to trace that will be difficult. And since it is a time-bound activity, and we have seen that if the account goes in red, so whatever things has to go wrong would have happened maximum in last 5 years. So last 5 years is more than enough for one to cover the fraudulent transactions. Start with section 43 on the preferential transactions. So here the preference is being given to the by the corporate debtor, who is the account which has gone for the default. He has given some preference to the transaction either in terms of buying of the assets or doing any OPEX transactions which has which I will say would have been at the disadvantage to the creditor. It may be the financial creditors, that is largely the lenders, or OPEX creditors. So how one reviews those transactions, whether those preferential transactions has happened or not, and we use the principle of arm's length price. And basis which we see whether such events has happened or not, and we pull out those events as part of our detailed report. And we also bring and map it without the scope of work. So against the section, what all our opinions are there, which are those observations. So I've given here one example where there has been an investment done in a, say, subsidiary company or associate company. That doesn't mean that it is a preferential, but then if he doesn't even have the ownership to hold those assets, then how I qualify it as a preference, that it is a clean transaction. The reason for classifying it as a preferential transaction, there may be something more over here. So in this particular case, while I do not have the ownership of the assets, I am showing in my books those amount paid as a investments, but there may be some underlying obligation on the target company or the corporate debtor, where he is supporting to his holding company or associate company to buy those securities or provide corporate guarantee. Next, I'll cover on the undervalued transactions, which is section 45. So here the law talks very simple way that either there has been a gift or he enters into a transaction which involves transfer of one or more assets by the corporate debtor for a consideration, the value which is significantly less than the value of the consideration provided by the corporate debtor, and such transaction has not taken place in the ordinary course of business of the corporate debtor. But I can have other way also of the transaction where I am purchasing from my related party, group companies, at a very high price. It may be assets or a OPEX, maybe on the backward integration or forward integration front. Or I may be buying some assets which are not even at all relevant. If I do the market intelligence and I see that the normal price at which it should be made available. So this is nothing but transferring of the funds or the profit from the company to the group companies. Apart from the definition where we see there has been a sales to those group companies at a lesser price. It may be even sale of the assets. So we classify as a forensic auditor such transactions under section 45. Then there is a section 50 which talks on the extortionate transactions. So usually we come across very less such transactions. But if such transactions are there, definitely we do report. What is extortionate transactions? So if there is an item which is having, say, mobile handset business I am into, a standard mobile is costing 10,000. But if I am selling that mobile at a, say, just figure 500 rupees rather than at 10,000, then it's a very extortionate transaction where I am significantly transferring huge profit to the group company. If it would have been, say, 9,000 or 8,000, it would have gone for the undervalued transactions. So that is what the difference is between section 45 and section 50. Now the key section where the focus is usually there is on the section 66. One more thing prior to I move on 66, whatever the potential impact is coming up and under section 43, 45, 50, the NCLT, if it admits such transactions, the entire value of those transactions gets reversed, meaning that that much amount is proved to be a fraudulent. In section 66, we have the impact to the extent of whatever the differential amount is there. Now, section 66, as it talks for the fraud, so one knows now what is fraud. And say, I think I'm running out of time. I may have to log in again if I go out. So I continue in the interim.
Mitesh, you continue. At the
Yeah.
Zoom message, it says it's continuing. There's no time limit.
Okay. So here we have, I'll share one very classic example over here. there is one target company, that is a defaulter company, where we have observed that the amount he has borrowed as a loan, say 100 CR, and he has given to holding company, because holding company was sitting as his operational creditors and he has to pay him. And that holding company, we said if the holding company has liability of 2500 CR, for example, I have just borrowed 100 CR from the bank and given it to him, and what is your terms of sanction agreement with that bank for borrowing? When we went further to ask the end utilization with the holding company, here we came to know it is nothing but the holding company has the liability due of the same 100 CR with the same bank, wherein they have to repay. Now, resolution professional was in such a dilemma state where the mandate has come from the banks to him. He has to protect the bank also. At the same point of time, I have to ensure my independence. So we have worded in a manner where we have ensured that our independence is being retained, as well as the fact is being brought out clearly. So there is one provision over here in section 66 where we say that if the director or the partner doesn't exercise due diligence in minimizing the potential loss of the creditors, because I see, for me, the corporate debtors creditors, are they at disadvantage in this particular example? The answer is yes, they are at disadvantage, even though is another debt in the same group is getting replenished. So this is nothing but what was happening at the bank's end was he was covering up one NPA in one group company by giving a fresh loan in another group company, and that group company happens to be a corporate debtor. So we had a lot of heated argument and a debate over here that how can you classify the money has gone to the bank, the end use has that it has not moved out from the system, it has been paid to the creditor, it is shown in the books, and it has been audited even in the previous year. But then we took that stand, and finally the resolution professional admitted that case on the basis of section 66 subsection 2, that directors have not exercised his due diligence. Because here the catch what we had was that even though you have paid to the creditor, but how that creditor has come in your books, because you have purchased the investments and those investments are not even owned by you. So that was some, I will say, the catch we have, basis which we were able to put forward our point. Then there are a few more examples, like there is a sale of assets which are a transaction which happens where I have to sell some assets, and that assets belongs to my company. But then I transfer those assets to my group company. If that asset value is 100 CR, I transfer it at 80 CR. So 20 CR profit I am diverting from the target company to the parent company. So that is a diversion of funds. And one has to go to the extra mile in terms of how those 20 CR profit has been coming in, because we don't have access to those group company accounts also over here. But if one reads the deal, the structure of it, and you see the amount paid, and if that acquiring company is also a listed company, and one reads from the balance sheet, one can correlate, okay, the money has been transferred, the profit has been transferred. Then we come across very common example. If a net worth of the company is say 100 CR, he gives the corporate guarantee for his group company which is far beyond his net worth. And section 186 of the Companies Act also talks, if such is a case, then one has to be reasonable enough. Special resolution has to be passed in the board meeting with the explanatory notes. And if such violations are there, one can classify under section 66 of IBC. So these are some few findings which I feel we have come across in various cases during our practical experience, which I felt I should share with you. Thank you.